Commodity traders like Cargill or Glencore routinely use futures to hedge price risk. Suppose a wheat exporter expects to ship 10,000 tons of wheat in 3 months. If prices drop, their revenue could fall sharply. By selling wheat futures today, they lock in a price and hedge against a potential price decline. If the market drops, the loss on the physical delivery is offset by gains on the futures contract. This is a prime example of how futures help stabilize earnings in volatile markets. A futures contract is a standardized legal agreement to buy or sell a specific quantity of an asset at a predetermined price on a future date. These contracts are traded on organized exchanges like the CME, Chicago Mercantile Exchange, and are used widely in equities, commodities, interest rates, and currencies. Standardization ensures high liquidity, transparency, and the involvement of a clearinghouse reduces credit risk. Standardized terms mean that quantity, quality, delivery time, and location are all predefined. These contracts are exchange-traded, which ensures liquidity and fair pricing. Positions are subject to daily settlement, meaning all positions are marked to market every day. A clearinghouse acts as counterparty to all trades and reduces default risk. To open a futures position, traders must post an initial margin, a fraction of the total contract value, usually 5 or 15%. This acts as collateral. There are several types of margin. Initial margin is required to initiate a position. Maintenance margin is the minimum account balance to keep the position open. Variation margin refers to funds added or removed daily based on gains or losses. If the account balance falls below the maintenance margin, a margin call is triggered, requiring the trader to add funds or close the position. Futures positions are revalued daily to reflect market changes. Gains or losses are credited or debited to the margin account. For example, if a trader holds a long futures contract on oil and the price increases by $2 per barrel, the gain is immediately added to the account the same day. This ensures transparent, real-time risk management, but also means losses must be covered instantly. Opening a futures contract occurs by buying or selling. Mark-to-market involves daily valuation that adjusts the margin account. Closing the contract is done by taking an opposite position or through final settlement. Settlement can take 2 forms. Physical settlement requires delivery of the asset, while cash settlement is based on price differences. Hedgers, such as producers, exporters, and importers, use futures to fix prices. Speculators are traders betting on price direction using leverage. Arbitrageurs exploit price inefficiencies between futures and spot markets. Leverage amplifies losses because small price moves can lead to significant gains or losses. Liquidity risk may arise in less active contracts as not all futures contracts have deep order books. Basis risk occurs when the futures price does not move perfectly in sync with the underlying asset. Understanding these risks is crucial for anyone trading or hedging with futures.